This is a demonstration of problem 229A, journalizing transactions, posting journal entries to T accounts, and preparing a trial balance. So the problem states that Vincent York practices medicine under the business title Vincent York, MD. During July, the medical practice completed the following transactions, and they give us all of the transactions for the medical practice for July. And the business uses the following accounts, and the problem gives us the accounts that the business uses, and the requirements state in Part 1 to journalize the cash transactions, but no explanations are required, then to post the journal entries to T accounts, and then to prepare a trial balance as of July 31st, 2024. So we will start out with analyzing the transactions to determine how to prepare the journal entries. On July 1st, York contributed $63,000 cash to the business in exchange for common stock. So we know that the business received $63,000 from York and issued him common stock. So we would debit cash and we would credit common stock. On July 5th, it states that the business paid monthly rent on medical equipment of $510. So we know that we would have a credit to cash and our debit would be to an expense account. So we would look at the accounts that are given in the problem and we see that the one that would match would be rent expense. So we would debit rent expense for $510 and we would credit cash for the same amount. On July 9th, it states that he paid $23,000 cash to purchase land to be used in operations. So we know he paid cash, so that would be a credit to cash, but what our debit would be land. So we would debit land for $23,000 and we would credit cash for the same amount. Then on the 10th, it states that they purchased office supplies on account for $1,600. So remember that on account means we did not pay cash. So this would be an accounts payable. We got office supplies, so that would be our debit for $1,600 and we would credit accounts payable for $1,600. 19 states that we borrowed $22,000 from the bank for business use. So when we borrow money, that means we got $22,000, so that would be our debit to cash. But what would our credit be? Again, you would need to look at the accounts that are given to you in the problem, and we would be looking for a liability. Now there are different types of liabilities, so we can see several different liability accounts listed: accounts payable, advertising payable, unearned revenue, and notes payable. When you borrow money from a bank, it is a note payable. You sign a note in order to borrow the money. So that would be our credit. Sometimes you just have to read all of the choices that you're given until you learn this and can pick out, sometimes by virtue of elimination. Next, it states that we paid $1,100 on account. So when a problem states that just $1,100, so we know we paid cash, and it just says on account, it's referring to accounts payable. If it was saying the note payable, it would state paid $1,100 on note payable. So in this case, we're reducing accounts payable, so we would debit accounts payable for $1,100 and we would credit cash for $1,100. On the 28th, it states that the business received a bill for advertising in the daily newspaper to be paid in August for $240. So remember, we're in July. This means that we got a bill, but we're not paying cash right now, okay? But we've already received the advertising. So this would actually be real advertising expense for $240 because it was for this month, but we're not going to pay it until the next month. So that is the reason why it would not be cash that we credit, but a liability because we owe that amount. We will pay it next month. On the 31st, it states that revenues earned during the month included $6,400 in cash and $6,000 on account. Okay, so this is like we're making all of our revenue entries at one time. We're adding them all up. He's seen patients all month. Some of them paid cash and some of them received credit. So we know that we would debit our cash for the $6,400 and we would debit accounts receivable for the $6,000. Then we would add those two amounts together, and that would be a total to service revenue for $12,400. Okay, so just add those amounts together if they don't give you the total. The next entry says that we paid the employees' salaries for $2,200, the office rent for $1,900, and the utilities for $560, and they want us to record a compound entry. So first, let's talk about what a compound entry is. A compound entry is more than one debit and more than one and can be more than one credit. But in this case, it's going to be 3 debits for 3 different expenses and 1 credit. In other words, it's telling us don't make a separate entry for each one of these. Put it all together in one entry. So the salaries expense was $2,200. The rent expense was $1,900. And the utilities expense was $560. And you would just add those together and do 1 credit to cash for $4,660. Next, the business received $1,120 for medical screening services to be performed next month. So someone has paid money in advance. And if you remember, we talked about this in the previous problem. We received money, but we have not performed the services. So this would not be service revenue. This would be unearned revenue. So we have to set up a liability for $1,120 because we owe that customer those medical screening services next month. Then the last entry states that we paid cash dividends of $7,200. So again, dividends would be a debit and we would credit cash for the same amount. Part 2 states to post the journal entries to the T accounts using the transaction dates as posting references and then label the balance of each account as a balance. So to save some time, I have actually gone ahead and posted all of these entries to T accounts, but I will show you how this works. So on July the 1st, we had a debit to cash. So we go down to our cash account and I would record a debit on the T account on the debit side for $63,000 and the date is the posting reference. And you do that for all of the debits, and all the credits. Okay. Now once you get all of your debits and all of your credits posted, and cash always has the most, you add all the credit side and all the debit side, and the bigger side, which should be the normal balance side, will be where you post the balance. So you would add all of these and then subtract all of these to get the balance in cash. Now some of the accounts only had 1 entry, like accounts receivable only had 1 entry. So that's easy to do. That's going to be the balance. Usually if you make an error in this, you have posted something to the wrong account, you have posted the wrong amount, or you have posted to the wrong side of the account, or you didn't add correctly. Okay, so those are the kinds of errors that occur. I think posting to the wrong side is usually the most common error that students make. One way that you can kind of check yourself to see if you might have posted something on the wrong side is to look down your balances after you get them and see whether they're on the normal balance side. All of your assets should have debit balances. All of your liabilities and owner's equity accounts through common stock should have credit balances. Dividends should always have a debit balance, service revenue a credit balance, and all of your expenses should all have debit balances. So that's one way to check if you may have posted something on the wrong side. Otherwise, it's going to be something you either put the number in there wrong, like you didn't put 1600, you put 1500, or you posted it to the entirely wrong account, like you might have put accounts payable and advertising payable or something like that. Now, the third part of this problem is to prepare a trial balance as of the end of the month using these numbers, these balances in these accounts. So this is where you're going to find out if you've made an error. Because remember, that is the purpose of the trial balance, is to see whether or not your postings and your amounts are in balance. Because all of your debits have to equal all of your credits. And that's how you find out. That's the whole purpose for doing the trial balance. So I have put the accounts in order. All of the accounts are listed. And now we're going to see whether or not we are in balance. So you just, now that you have your balances, you don't even have to guess. You can see that cash is a debit balance. Accounts receivable is also a debit balance. Office supplies is an asset and has a debit balance. Land has a debit balance. Okay, so those are our 4 assets. They should all have debit balances, normal debit balances. Then we go to accounts payable, and they have our liabilities have credit balances, and we should be looking on the credit side and if there's not a balance on the credit side, then you may have a problem. You can go ahead and start looking for that problem before you even get to this point. But common stock, again, stockholders' equity, credit balance. Okay, those are our permanent accounts. And then remember, on the trial balance, then we always start with dividends. And dividends has a debit balance. Remember, dividends is similar to an expense. And then we go over and we pick up service revenue, which has a credit balance. And then we're going to list all of our expenses in order. So salaries expense, $2,200. Rent expense is $2,410. Utilities is $560, and advertising is $240. So $560 and $240. And this is what we're looking for. We're looking for these debits and credits to equal. So that is how we check that we have actually posted our entries and added our accounts, gotten our balances correctly. Now, does that make all of your records correct? No, it doesn't. If you use the wrong account when you were doing your journal entries, then it could be that something that you really should have debited to a different account, you put in the wrong account. So it doesn't prove that your records are perfect, but it just proves that your debits and your credits do equal, so we can be fairly sure before we go into the adjusting process that our accounts are actually in balance. And that is the conclusion of the demonstration for problem 229A.